Welcome to Accounting Matters. I'm Nicole Harger, Senior Managing Director here at Embark.
And I'm Adam Olsen, Embark's National Head of Practices. And we're entering episode 3 of the final installment of our DISE podcast series.
Yep. So in episodes 1 and 2, we covered a lot of ground on what DISE requires, relevant expense captions, the 5 natural categories, and all the technical details around how to classify different types of costs.
Yeah, and by now I would say hopefully people have started to gain at least a decent understanding of what the requirements are themselves. But I think beyond just those requirements of the standards, we're starting to get a lot of questions from clients and prospects asking things like, okay, I know the 5 categories, I know what's relevant, but how do I actually do it? Like, how do I actually start putting this standard into motion? Where do I start? What's step 1? How do I start building this capability within my organization?
Yeah, right. Because understanding the requirements is one thing, but actually building the infrastructure to actually produce the disclosure quarter after quarter, that's an entirely different challenge that companies are going to face. And so to help us tackle that challenge, we've brought in a special guest today.
Yeah, we're excited to have, not to leave him hanging. He's been here, obviously listening on this opener, but excited to welcome David Bushby, who's a managing director here at Embark in our financial accounting advisory practice. David works with a lot of public companies, both prior to Embark and during his tenure here at Embark, really helping those folks out, just focusing a lot on consumer products and the retail space, right, David? And I know those industries are vastly impacted by DISE and some of the complications and complexities of the standard. But I know you've also started kind of kicking off projects with clients in this space. So we're excited to have you. I know you're going to bring a lot of great ideas, thoughts, perspectives. So welcome.
Yeah, thanks, Nicole. Thanks, Adam, for having me. Like I said, long-time listener, first-time joiner, so I'm excited to be here today. And you're right, that question about how do I actually do this is one I'm getting most often right now. Clients have read the guidance. They generally understand they need to disaggregate certain income statement line items into natural categories. But when they think about their current systems and data, how it's organized, where it lives, whether they can even access it in the format they need, that's when the real complexity becomes apparent.
Yep. And so that's what we're going to focus on today, really building and outlining a practical roadmap from getting where you are today to being ready for that first disclosure. Okay, so let's start with the critical first step, the readiness assessment. And I can't emphasize enough how important this is. So we are already in early 2026, which means for calendar year end public companies, you've got less than 2 years until your first DISE disclosure in your 2027 financial statements. And while 2 years sounds like a lot of time, you're going to have to factor in potential system changes, testing, dry runs, control implementation. And so that timeline really compresses very quickly. The readiness assessment is where you identify your relevant expense captions and you do an honest evaluation of what data you currently have versus what you need for each relevant caption. So typically your cost of sales, SG&A, R&D, you're asking, can I identify employee compensation? Can I separate purchases of inventory? Can I break out depreciation and amortization? And be really brutally honest about whether you can get all that information from current systems and whether you need to build new capabilities or use estimates.
Yeah, and I think what we're finding across companies that we're talking to is that most companies feel like they have some of that information, but not all of it, right? It's rarely exists today in the exact format or level of granularity that a company is going to need to meet the DISE requirements. So for example, if you think about employee compensation data, maybe the total employee compensation for the company, or you should know that, right? It's the payroll system number that you can pull out. You disclose it somewhere in total, and maybe included in your proxy filings or other disclosures. But when you think about it in the context of DISE, you can't always easily break it down by which expense caption it hits. So how much of that comp is actually sitting in cost of goods sold, SG&A, R&D. Your GL may not be set up in a way that actually tracks it across that different dimension. So accounting systems need to be thought through. Department codes are likely not mapping things to the right expense caption. So there's just a lot of nuance there. And that's just one example. Another one could be around purchases of inventory data. Again, you may know total purchases of inventory for the year. Your procurement team can likely tell you that information. You've got that somewhere along the lines. But as far as distinguishing some of the nuances from the disclosure itself, so whether business combination inventory has been segregated from routine purchases, how do intercompany transactions play here, right, versus your external purchases, you have to be able to delineate between those two. And then thinking about just some of the complexities we have today around just the costs that go in. So with tariffs and things like that, that we're talking about more frequently in recent months here. That's just another example of where we're seeing some complexity.
You're right, Adam. I'm seeing this play out in real-time conversations with our retail clients. Most of them could tell you the total cost of goods and generally how much they spent on inventory purchases. But when you ask them to separate purchases of inventory components out further into items like warehousing labor, distribution center depreciation, freight costs, especially if they're using the retail inventory method or have complex distribution networks, that's when the gaps really start to emerge. For example, one company highlighted they have inventory flowing through 5 different distribution centers, each on different systems. And they're realizing that they need a completely new data aggregation approach to get a consolidated view by natural expense category.
Yeah, so once you've actually done the gap analysis, you need to build your cross-functional team. And really, this is non-negotiable. So your finance team or your accounting team cannot do this alone. You need both accounting, your FP&A, IT, operations, procurement, and HR at the table, because each one of these functions owns critical data that is needed. HR has employee classifications, payroll has compensation details, procurement has purchase data, inventory management has costing information. And so you need that executive sponsorship, whether that's CFO or a controller that's actively supporting this initiative. And we're seeing the most success with companies that treat DISE like a strategic initiative with dedicated resources and not just kind of a compliance checkbox.
Yeah, and then from there, I think comes some of the key decisions that you have to make. So one of the biggest ones we're seeing companies, especially those that carry inventory, is the election of, do you view purchases of inventory through the cost incurred kind of approach or the expense incurred? And that decision is really going to drive a lot of your downstream kind of requirements. So again, just to re-emphasize here, I know we covered this a bit in episode 1 or 2 or probably both, but just to recalibrate here, expense incurred requires the tracking the original nature of cost through inventory over time. Cost incurred tracks current period activity, which is often a more feasible approach for a lot of companies. But again, that approach will require you to consider a number of reconciling items to actually comply with that disclosure. So, like I said, this is a policy decision that companies are going to have to think through. And then in addition to just kind of this approach on purchases, there's other broader decisions that have to be made around inventory. We've already mentioned the tariffs once, but again, just kind of how you think about tariff costs. Are you viewing it through a broader view or a narrow view on whether you include or exclude some of those costs? So those are just some examples of some key decisions that companies are going to have to navigate.
And what we're currently seeing in the retail landscape in particular is most companies are choosing the cost incurred method because, to your point, Adam, the expense incurred method is just way too operationally complex. As an example, we have a consumer products company who has LIFO as their valuation method for inventory, and they would have to potentially go back 10 years to determine and identify the natural expense composition under LIFO layers. That's not practical. They're going cost incurred and focusing energy on accurately tracking current period activity.
Yep. And so once you've actually made key decisions, you design your process. So your data flows, responsibilities, timing, approvals, controls. And here's kind of critical timing guidance. So we recommend doing at least one full dry run during 2026. So pick a quarter, Q1, Q2 or Q3, and try to produce the full disclosure. And this will give you time to identify any issues, refine your approach, and implement fixes before your 2027 reporting. And if you are adopting retrospectively to provide comparative periods, you'll need 2025 data, which you just closed. So you'll need to track 2026 data with the same rigor throughout this year.
Yeah. No, good points there. So let's pivot next to talking about just systems and data challenges. I think this is an area where most companies are going to kind of meet more of the roadblocks and kind of the implementation of the standard. And I think a lot of it, like we talked about kicking off here, is the fundamental challenge I think a lot of companies are facing is just that data fragmentation. So the information you need for DISE doesn't live in one place. It's scattered across your GL, your payroll systems, maybe HR, procurement, inventory management systems, fixed asset systems, you name it, right? Those systems in a lot of environments don't talk to each other very well and aren't integrated to really make that data easily accessible. And that's, inherently a lot of the challenges we're hearing from several clients.
Yeah, and we're especially seeing that in the retail space. We have one retailer who operates in multiple countries, each on a different ERP system and different inventory management approaches to top it off. They're building a completely new data aggregation layer to pull everything together and map it to the natural expense category. It's a significant investment, but they realized there was no other way to produce this level of data for the required disclosures.
Yeah, and it's not just about like that technical integration, right? It's data quality, it's data consistency. If you've got different business units that are coding things differently, or interpreting definitions differently, if you've got some kind of framework that they're following, you're going to have those inconsistencies. And so I think that's where data governance really is critical. When you think about DISE implementation, you need standard definitions like, hey, what counts as an employee? What counts as purchases of inventory? And making sure that's applied consistently across all your different locations or all your different entities. And kind of to David's point here about multinational companies, employment laws, for example, may differ by jurisdiction, procurement processes may differ, inventory practices may differ. So companies will really need to think about setting some type of like global standard or framework, while accounting might have to still legitimately account for those local differences.
Yeah, and let me talk about another common scenario we can expect many companies to face. So companies using multiple ERPs domestically, often from acquisitions. So for example, you might have 3 to 4 different ERP systems with a different chart of accounts. And so you've got different expense coding, different detailed levels. And so in order to produce a consolidated DISE disclosure, you're going to need to map all of those systems to a common framework.
Yeah, and some companies I think are building data warehouses. They're using reporting tools that kind of pull from multiple sources. So there's a lot of different technologies out there that do exist to help kind of streamline some of this. I think others are taking the opportunity to really standardize those chart of accounts across systems, which is a bigger undertaking than I think some may realize, but it does provide long-term benefits that are just beyond DISE compliance alone too, if you think about the benefits of that. And we're also seeing companies struggle with cost pools and allocation methods. So if you're allocating overhead to inventory using pools rather than tracking costs directly, you need to estimate the natural expense composition of those pools.
Right. And here's a retail specific challenge that we're seeing: the retail inventory method. RIM is an acceptable way to approximate inventory costs under ASC 330, but it doesn't naturally provide cost composition detail. So retailers are having to layer in an additional tracking on top of the RIM to capture purchase of inventory separate from markups, markdowns, and shrinkage. One client is implementing a supplemental tracking system just for DISE that runs parallel to their RIM system. It's not ideal, but it's more practical solution given their business model.
Yeah, and I think that's where the standards provision around allowing the use of estimates can be really valuable for a lot of companies. So again, just for reference, this was covered in episodes 1 and 2, but for those that may have missed that piece, the use of estimates or methods that produce reasonable approximations are permissible. The FASB included that as part of the standard, just recognizing that transaction level precision could be burdensome or impossible depending on the circumstances for some companies. Like any estimate in your financial statements, right? Your estimate needs to be systematic, rational, supportable, and consistently applied. Obviously, for best practices, document that methodology, document your data sources, the assumptions you're making. Your auditors will appreciate that when time comes and they start asking questions.
Yeah, and so something important to note about estimates, right? Just like in any other area of GAAP, you need to reassess them periodically. So if your workforce mix shifts from employees to contractors, or if your supply chain changes, you're buying different types of materials, your estimation approach might need to be updated. And so building a process for periodic recalibration. And then also remember materiality. If employee compensation is 70% of SG&A and office supplies are 2%, focus your precision on employee compensation, right? Supplies can be a rougher estimate kind of in your other items category.
Yep. And maybe one other system consideration from a retail perspective, seasonality. Consumer products and retail companies often have huge Q4 holiday sales with dramatic inventory swings. Under the cost incurred method, your changes in inventory line is going to be large and volatile quarter over quarter for this reason. That's fine from a compliance perspective, but you might need additional context and disclosures in the MD&A to help investors understand these movements. Your processes need to work at any point in the year, not just when inventory levels normalize.
Yeah, good point there. Let's turn the table a bit here and talk about common challenges and best practices that we're seeing and maybe how we would address some of those. So I'll kick off with a couple here. So challenge one that I think a lot of companies are facing is around intercompany eliminations, right? Especially for vertically integrated companies or those with significant intercompany inventory transactions. Tracking back to that original external purchases at the consolidated level is going to be often difficult, especially when your systems aren't designed to already track that information. Second challenge I think we're seeing here is around the employee versus contractor distinction, especially, you just kind of mentioned seasonality there. There's probably a lot of retailers that employ a lot of seasonal employees that, or may not be employees, but contractors at that time of year. And I think we see this with a lot of organizations, right? There's blended workforces that are in use, right? And systems don't always clearly flag kind of who meets the definition under GAAP, so that ASC 718 definition of an employee versus who's just a contractor. Again, this is challenging if you're using a staffing agency or a PEO where the employment relationship is also maybe less clear and a bit more ambiguous.
Yeah, and then I think the third challenge is inventory costing methods and detail levels. So companies using standard costing, LIFO, or the retail inventory method aren't tracking costs at the granular natural expense level. So they're finding it challenging to identify what's embedded in inventory. And then challenge 4, organizational change management. So this requires coordination across functions that don't normally collaborate closely on financial reporting. So getting procurement, operations, and HR to kind of understand why finance needs this information and to provide it consistently is a people challenge. It's not just technical.
And I'll add a fifth challenge from a retail perspective, store level expense allocation. Many retailers allocate corporate costs down to store management reporting, mainly for operational purposes. Those allocations might not align with how they need to disaggregate from a DISE perspective. So they're having to build separate allocation methodologies or use estimates to get the right natural expense view at the consolidated level.
Yeah, and so I think given all of these challenges, we should probably talk about some best practices. I think first you need to move quickly on your readiness assessment. Like we've kind of hinted on already, we're in early 2026, so don't delay. I think second, you need to leverage existing processes where possible. So if you're tracking information for management reporting or segment reporting, use that as a starting point. Don't reinvent the wheel if you don't have to. I would say third, document your decision-making process. So for key judgments, which inventory basis, what's in purchase, how you define selling expenses, document all your alternatives you've considered, why you chose your approach, how it aligns with your system and businesses.
Yeah, and just to add on to that, so fourth, we kind of hit on this one, do a pilot. And maybe it's not doing a full pilot of everything that needs to go into all the DISE disclosures, but maybe you start with picking one relevant expense caption as kind of an entry point here. So think about which of those relevant expense captions have kind of the natural expense categories and pick your largest. So if cost of goods sold is it, start with that one and produce the disclosure for the most recent period. See what data you can get, where you're hitting those roadblocks. Again, what estimates maybe you're identifying that are needed to help make that disclosure complete. And I think that learning really can then inform your broader approach as you start to apply it across other relevant expense captions. Fifth, I think, is investing in just change management type stuff here. So communicating across the organization, training, individuals that are going to have to provide information for DISE or be involved in the process in some capacity. I think, this can be people in procurement, people that are coding expenses. They really just need to understand the importance of maybe why you're doing these changes, why these classifications, why this new way of thinking through expenses matters. And they need to really understand kind of how this all, ultimately what they do day to day impacts what flows into those financial statements.
Yeah, those are great points, Adam. And I'll share a success story on a client that did a pilot project in Q3 of 2025. They looked at their cost of goods sold, another retailer, and discovered that their procurement system couldn't easily separate inventory purchases from equipment or supply purchases. That discovery led them to enhance their vendor tagging process, which became a new control, and they implemented it in time for 2026 data collection. If they waited, they would have been scrambling. The pilot was an invaluable lesson for the company.
No, so I think it definitely was valuable for them. And then I would say, I guess another best practice would be build in testing and validation time. So you want to validate that your amounts are reasonable, that they tie to the financial statements, that your qualitative descriptions all make sense. You don't want to discover errors when filing your first 10K with this disclosure, right? And just again, on estimates, standard allows them, but reasonable approximation is key. And so your estimate needs to be supportable and rational.
Yeah, those are great points, Nicole. And what I'm seeing is different estimation techniques by category. For employee compensation, headcount-based approaches work well. For purchases of inventory in retail, some clients use a percentage of COGS based on historical purchase patterns. For depreciation, they use fixed asset reports allocated by department. The key is documenting why each approach is reasonable for the specific category and your specific business, because this will help the auditor in turn when it comes time to audit the standard.
And so I guess speaking of auditors, let's maybe pivot the conversation a little bit and talk about internal controls and audit considerations, right? Because this is a new financial statement disclosure. It needs to be covered by ICFR. You need controls over data completeness, accuracy, controls over calculations, classifications, and controls over review and approval. And so this needs to be designed and operating before your first disclosure. For data completeness and accuracy, controls ensure all expenses are captured and classified into the right natural categories. And then, for example, that employee versus contractor designations are correct and that intercompany eliminations are accurate. And so this might actually mean implementing controls in source systems. So controls over employee classification in HR or controls over vendor setup and procurement.
Yeah, and I think in addition to that, right, you're also going to need controls over the disaggregation logic itself, right? So how are you allocating those shared costs? How are you applying the estimates we've talked about a handful of times already? What's your process for identifying items that need separate reporting under the integration of other GAAP requirements? That's, a requirement of the standard itself. You need to think about your management review controls, right? So someone with the appropriate knowledge is reviewing the disclosures to ensure that it makes sense, ties to financials, right? It's consistent with prior periods, et cetera, et cetera. And then system controls, right? If you're building data feeds, like we talked about integrating all these systems. So if you're building data feeds from all these multiple sources, you need controls ensuring those feeds are complete and accurate, that the data mappings are correct, that the system changes don't break the process.
That's exactly right, Adam. And from a practical perspective, I'm seeing companies build review controls at multiple levels. Detail review at the preparer level, the person pulling the data, validating that it's complete and accurate from an IPE perspective, that's critical. Analytical review at the manager level, does this make sense compared to prior periods, budget, and what do they know about the business? The final review by the controller or the CAO before it goes into the financial statements as well. That multi-layered approach catches errors at different stages throughout the process.
Yeah, and so also from an audit perspective, right? They are going to need to understand your process, test your controls, validate your data sources, and evaluate reasonableness of your estimates. And so they're going to take that disclosure, tie it back to your income statement. They're going to test classification into the natural categories. And if you're using estimates, they're going to evaluate your methodology and assumptions. And so the better documented your process is, the smoother the audit.
Yep.
And I would also go so far as to recommend, like, you start having those conversations with your auditors now. Don't wait until you're filing your first 10K. Talk to them about your implementation approach, key judgments that you're using, and your use of estimates. And so get that feedback early so you're not making changes last minute.
Yeah, Nicole, I would add to, if you identify control deficiencies during implementation, address them now. Don't wait for the auditor to find them. Early identification and remediation puts you in a much better position for success on the first year of adoption.
All right. I think definitely great advice there on, as we, companies think about internal controls and definitely thinking about kind of next steps and with DISE implementation and working with their auditors. But I do want to go ahead and pivot the conversation to, I think, another area we're starting to have clients ask some questions around, and that's really how DISE interacts with other disclosure requirements. And the one in particular where I think we're getting a lot of questions is around segment reporting under ASC 280. Because if you think about it, companies are now going to have to provide disaggregated expense information in two different places with kind of two different methodologies. So first, under ASC 280, that was updated recently, right? So ASU 2023-07 kind of added the disclosure of significant segment expenses as a requirement of that disclosure itself. And that's going to be based on, right, expenses that are regularly provided to the CODM and included in segment profit or loss. That's a management approach view, right? As you think about how you apply segment reporting requirements, you're disclosing what management looks at. On the contrary, under DISE, you're disclosing specific natural expense categories based on more or less what the FASB defined in the codification, right? And that's a standardized approach. That's not management-based. So really, companies here are going to be kind of putting out expense disclosures that really have different categories and different amounts that are going to exist within the financial statements.
Yeah, that's a great point, Adam. And I will give a practical example of where we're seeing this happen. We have a retail client that has 3 operating segments. They provide employee compensation data to the CODM by segment, but it includes contractors because that's how they manage their business. For segment reporting, they disclose it that way. For DISE, they have to separate out true employee compensation per 718 definition. So they're going to have 2 different employee compensation numbers in their footnotes. They're planning to add a clarifying note that the segment expense uses their management definition while DISE uses the codification definition.
Yeah, and that's a smart approach because you want to avoid confusion for financial statement users. The interaction with MD&A is also worth considering. The DISE disclosure provides detailed cost structure information in the footnotes. Some of that will be relevant to discuss in MD&A when explaining changes in results of operations. If employee compensation and cost of sales increase 20% year over year, that's information investors are going to want some context around in MD&A. And so the DISE standard doesn't create new MD&A requirements, but companies should think about how DISE information informs their MD&A narrative and ensure consistency between the two.
That's correct, Nicole. And I'm actually encouraging my clients to think about DISE disclosures as informing investor communications more broadly, whether it's through earnings calls, investor presentations, or quarterly commentary. If you're seeing significant shifts in natural expense categories, like a shift from employee compensation to automation and depreciation, or increases in purchases due to tariffs and changes within the supply chain, that's a story investors want to understand. Mm-hmm. The DISE disclosure provides the data, but you can use it to tell a strategic story about how you're managing your cost structure.
Yeah, and I think the other interaction that we want to mention here is the tabular disclosure that integrates certain expenses, gains, losses that are already required under other areas of GAAP. So impairment losses, restructuring costs, derivative gains and losses, kind of all that list 1, list 2 items that we highlighted in episode 1 and 2 of this podcast series. Those appear in the DISE table, but they're also still subject to all the other existing kind of disclosure requirements in the other footnotes under GAAP. So You might have impairment loss information, for example, in your DISE table, but you're obviously going to also have that included in your impairment footnote. So you just want to make sure that as you're kind of integrating these other items, that they are also consistently like presented and they're appropriately cross-referenced where it makes sense.
Okay, so let's maybe pivot a little bit. David, you've been chiming in on retail specific industry considerations. And so let's talk about that maybe more broadly and how the standard is going to look different across industries. What are some unique pain points, David, on the consumer products and retail side of things?
Yeah, that's a great question, Nicole. Retail and consumer products have several specific challenges. First, many retailers use the retail inventory method, which approximates costs but doesn't naturally provide natural expense detail. Companies are having to layer in additional tracking on top of RIM for additional costs incurred. Second, complex distribution networks. Inventory flows through multiple distribution centers, stores, e-commerce fulfillment centers. Tracking natural expenses composition through all those movements is very difficult. Third, as we mentioned, seasonal labor, holiday, temporary employees, summer workers, distinguishing who meets the employee-specific definition under ASC 718 versus who is a contractor, especially with staffing agencies, is complex. Fourth, many retailer and consumer product companies import significant inventory, so tariffs are a big component of purchase costs. They need to decide whether tariffs go in purchases of inventory or other items and apply consistently. And fifth, I would say, is private label brands where you're buying finished goods. Those are purchases of inventory, but the nature is different from buying raw materials.
Yeah, so it sounds like retail and consumer product companies have probably a bigger kind of hurdle to get over here as it relates to DISE, just thinking about all these challenges. And this is probably just a starting point of a list of things they'll have to think through.
For sure.
Yeah, so let's, maybe think about a few other industries outside of kind of consumer products and retailers and talking through some of those challenges. So if I'm thinking about like a manufacturing company, for example, that has complex production processes and significant intercompany transfers, they're also going to face that inventory disaggregation challenge. I think life sciences and biotech companies, they've got heavy R&D and collaborative arrangements. And so they need to focus on kind of the expense reimbursement guidance, as well as kind of the disaggregation of kind of those R&D costs and what all goes in there. Tech companies, think about significant capitalized software. Need to also then think through that asset-related expense guidance in the standard and how amortization would be classified. And then I think service companies also, right? They might struggle with, we kind of talked about it with the retailers here, but employee versus subcontractor distinction, especially with professional service firms like ourselves.
I think those are all great things to think about from an industry perspective. Maybe let's pivot and kind of share some final implementation tips on what we're actually seeing work well. I would say number one, don't try to be perfect out the gate. Your first disclosure doesn't have to be flawless. Use estimates where appropriate, document your approach, and commit to refining it over time. I would say number two, think about this as an opportunity, not just compliance. The disaggregation exercise reveals cost structure insights that's actually valuable for management decision making. So, we've had clients tell us that, going through this DISE preparation, that they're anticipating that it's actually going to help improve their internal management reporting and cost visibility. Number three, communicate with your board and your audit committee. Keep them informed about your implementation progress, key decisions that you're making, and challenges that you're facing. They all need to understand that this is a significant exercise, and so it's not just routine disclosure updates.
Yeah, and I'd add number 4 to that. Don't underestimate the timeline. I know we're in early 2026 now, but for calendar year-end companies, 2027 may feel far away, but it's really not when you factor in everything that needs to happen. Start your readiness assessment this quarter if you haven't already. And the other thing I would add, number 5, leverage external resources. Talk to your auditors, talk to industry peers, look at early adopter examples if they emerge. You don't have to figure this out on your own.
Yeah, and then I think just to kind of wrap up the best practices tips, if you will, I think number 6 is just making sure you build flexibility into your approach. if you think about the tariff conversation, right, trade policies are likely going to change. Your operating business model of your company is evolving. Systems are being upgraded. I think it's important that your DISE process that you maybe map out for implementation needs to have flexibility and the opportunity to be adaptable as those things kind of evolve over time. You don't want to build something that's so rigid and just works for year one, but then down the road, you're constantly having to refine and enhance. You want something that's already kind of have that infrastructure built in where you can pivot if facts and circumstances change.
Yeah, I think that's a really good point, and hopefully the listeners have found some of those tips helpful. I do think that kind of brings us to the end of our 3-part DISE series. As a reminder, episode 1 covered the why, the scope, and the timing of the standard. Episode 2, we really hit on the 5 natural expense categories and the application guidance. And then today we covered implementation, so the project planning, your systems, your data controls, interactions with other standards, and then industry considerations. And so I think the key message is, as we've talked about numerous times, is to act now, don't wait.
Right. And don't hesitate to bring in help. This is complex. It's new. There's no established playbook yet. Working with advisors who are helping multiple companies through implementation can accelerate your process and help you avoid pitfalls.
Yeah, I think the bringing in help point is very valid, right? This is a standard that's implementation is going to require a lot of different things for a lot of different entities. And so, and I know a lot of companies are already capacity constrained and resource limited there. So bringing in help to help navigate through the change management of a new standard of this magnitude, I think is important. And, that's obviously something we do as a firm here at Embark, help companies when it comes to adopting and implementing new standards, and DISE is no different than any others that we've helped numerous companies navigate through. And so, as always, we welcome people to reach out to us and connect with us on social. So on LinkedIn, reach out to Nicole or I, or also make an introduction to David, who's new on the podcast this episode. I know he'd love to entertain conversations around DISE and anything that you're facing or questions you may have. So this wraps up our 3-part series on DISE here that we did on the Accounting Matters podcast. Hopefully you guys have found it useful and enjoyed it. And as always, we look forward to welcoming you back on a future episode. Stay tuned.